Hello everyone, and welcome to this International Treasury Week session on tackling the regulatory hurdles. I'm James Winterton, Associate Director for Policy and Technical at the EACT, and your host for this session, which is being recorded and will be available afterwards on the event portal. As we've heard in previous sessions, currently treasurers are preoccupied by short-term funding issues, but the COVID-19 crisis risks distracting us from ongoing regulatory developments, and the crisis itself has given rise to new compliance issues. We've got a great panel lined up today to deliver an international perspective on these issues. And indeed, we have registrants from 80 countries around the world. It's a very big topic. And our ambition for the next 55 minutes is, firstly, to start with a factual overview to remind us of some of the existing regulatory developments, deadlines, and implementation challenges relevant to treasurers. After that, we'll discuss emerging regulatory hurdles and cases for forbearance, which means a temporary relaxation of the rules in the light of the COVID-19 crisis. Finally, we will share opinions on whether the current rules remain fit for purpose, and we will consider future regulatory trends that treasurers should expect to see. You'll see a Q&A button on your screen that allows you to submit questions. We'll try to tackle your questions as we go along, so please don't wait until the end to send them in. So let me briefly introduce our speakers. Bran Polk is a director at PwC, where he leads on the impacts of changing financial services regulation coming from the European Union. Hello, Bran, can you hear me?
Hi there, thank you.
Hi.
Thank you for the introduction.
Caroline Dawson is a partner in the financial regulation practice in Clifford Chance's London office. Hello, Caroline. Do we have Caroline?
Hello, hi.
Hi, well done.
Yes,
and
hello.
Thanks, Caroline. And Subhas Roy is a partner in Oliver Wyman, where he leads on the future of risk and compliance and on regulatory technology. He is also chair of the International RegTech Association. Hello, Subhas.
Hey, James.
Hi. And finally, but by no means least, we have Tarek Tranberg, who's head of public affairs and policy for the European Association of Corporate Treasurers, based in Brussels. Hello, Tarek.
Hi, James. Thank you for the introduction.
Hi there. So as I said, it's a global session, but to kick off, Caroline has 3 slides focused on European financial regulation, highlighting some of the key developments. Then we will open up the wider conversation with the rest of the panel. But first, Caroline, over to you.
Brilliant. Thanks very much for that, James. So a number of the post-crisis regulatory reforms had their foundation in international standards. And so if there are going to be delays in implementation of these reforms, it makes sense for the delays also to be coordinated at an international level. So we've seen announcements from BCBS IOSCO in the last month or so, clarifying the application of some of these requirements and then deferring the effective date of others. And you can see from the slide that a lot of these changes relate to the implementation timeline for bank capital requirements. But I think the measures that are going to be most relevant to corporate treasurers are those relating to extraordinary support measures and also the deferral of the final 2 implementation phases of the margin requirements for uncleared derivatives. So looking first at extraordinary support measures, BCBS is aiming to ensure that banks benefit from any flexibility in their capital requirements, and particularly the guidance on non-performing assets and on forbearance when those banks are assessing loans that are now going to benefit from new government guarantees or loans that are subject to payment moratoria introduced as a result of COVID-related disruption. And essentially, BCBS indicates that acceptance of government guarantees or payment holidays shouldn't automatically lead to the loan being considered to be non-performing or subject to forbearance. In relation to margin requirements, BCBS has proposed a 1-year extension to the deadline for the final 2 implementation phases. And that's really in order to allow firms to focus their resources on managing the risks associated with the current market volatility. So the final 2 implementation phases are, first of all, for entities with an aggregate average notional amount of uncleared derivatives in excess of 50 billion euro. And those entities are now going to be required to comply with the margin requirement from the 1st of September 2021, rather than September this year. And then the next phase, phase 6, is for entities with an aggregate average notional amount in excess of 8 billion euro, and those entities are now going to be required to comply with a margin requirement from the 1st of September 2022, rather than September next year. Of course, the international standards aren't directly effective in any particular jurisdiction. So we've also seen announcements from the majority of jurisdictions that have either already implemented margin requirements or that are in the process of doing so, amending their own legislation to allow for similar delays. So we've seen proposals from the in the US, the CFTC, SEC, and prudential regulators, from Canada, Mexico, the EU, Switzerland, Japan, Singapore, Hong Kong, Australia, and Korea. And all of these jurisdictions have announced deferrals to the implementation deadlines in line with those BCBS IOSCO recommendations. I think the exception here is South Africa. So in South Africa, the initial margin obligation doesn't start to apply at all until later this year. So as a result, the phase-in timetable just isn't aligned with those other jurisdictions. So again, the majority of these obligations are really primarily obligations for financial counterparties. So just to pick up on the issues which are going to be most relevant to corporate treasurers. So you'll see the first phase of reporting for the Securities Financing Transactions Regulation, or SFTR, was due to commence on 13th of April this year, and that's been deferred. And that phase really affected investment firms and banks, so deferral of the obligation doesn't directly impact corporate treasurers. But the fact that this reporting obligation was deferred did raise some hopes that maybe the changes to the EMIR reporting regime for OTC derivatives under EMIR refit might also be deferred. So if we look at the EMIR refit changes, these changes to the reporting regime are set to apply from the 18th of June of this year. And probably the biggest change that EMIR refit is going to make is requiring financial counterparties to report derivatives on behalf of their counterparties who are non-financial counterparties below the clearing threshold. And there's been some advocacy around delaying these changes, but ESMA confirmed actually this morning that it doesn't consider that delaying the changes would be an adequate way forward. And the reason for that is really that these changes are meant to reduce the burden on non-financial counterparties, even if that has the knock-on impact of increasing the burden on financial counterparties. So I think here really people should assume proceed on the assumption that this is going to start as planned on the 18th of June. Skipping to EMIR Phase 5 initial margin. Sorry, I think maybe we're a slide ahead. We should be on the slide marked 2020 rather than 2021. Perfect, thank you. So looking at Phase 5 initial margin, so on the top row towards the middle, we've flagged that the Phase 5 initial margin requirements are no longer going to start on the 1st of September, and that's really in line with BCBS IOSCO, as mentioned a minute ago. So we'll see that obligation pop up again on the next slide when we're talking about 2021. I think the last thing to flag on this slide is Brexit. So I think everyone will have seen announcements from the UK government that despite the recommendation of the IMF that it should extend the transitional period, the UK government has no intention of asking for an extension. And if the EU decides that it wants an extension, the UK would refuse that request. So as things currently stand, the Brexit transition period will come to an end at the end of this year, regardless of whether or not we've got an agreement on the long-term relationship with the EU. That has a little bit of a knock-on impact on some of the legislation, the EU legislation, which is then onshored into UK law. So clearly where we're seeing deferrals or extensions to deadlines under EU law, the question has got to be what's going to be the knock-on impact on the UK version of that. So if we see obligations deferred past the end of this year, are those obligations now going to be automatically onshored into UK law or not? And I think in some cases that's still an open question. Slide. So here, I think looking again at SFTR, the Securities Financing Transactions Regulation, so non-financial counterparties are going to be required to report securities financing transactions, including repo, buy-sell back, sell buyback, stock loans and commodities loans to trade repositories, very much in the same way that people are currently required to report derivatives under EMIR. And like that derivatives reporting obligation, there's going to be an obligation for financial counterparties to report on behalf of their non-financial counterparties. Here it's a slightly different definition. So whereas under EMIR, you're looking at mandatory reporting on behalf of non-financial counterparties below the clearing threshold, under SFTR, you're looking at mandatory reporting on behalf of non-financial counterparties who qualify as SMEs, as small or medium enterprises. And currently there's no proposal to delay this requirement. So the only requirement that's being deferred under SFTR was the initial one, which started in April. So at the moment, all of the other requirements are coming in as expected from July of this year. There's no current proposal to delay. I think the final point on this slide that I wanted to touch on, so obviously we've mentioned phase 5 initial margin delay already, so that's there on the slide. It's going to reappear in 1st of September 2021. I think the final point I wanted to touch on was LIBOR transition and the impact on that. So there's currently no proposal to change the expected end date for the publication of LIBOR. So the expectation is still that LIBOR will cease to be published as of the end of 2021. But I think where we have seen some movement is the working group on sterling risk-free rates has published a couple of statements addressing the impact of COVID-related disruption on LIBOR transition. And here, again, acknowledging the fact that with attention focused on risk management at the moment, there's reduced bandwidth for working on the transition process. So the original recommendation from the working group was that no new sterling LIBOR-linked loans should be offered after the end of Q3 of this year. And that recommendation is now being revised to recommend, first of all, that lenders should be able to offer non-LIBOR products to their borrowers by the end of Q3 this year. After the end of Q3 this year, lenders should aim to include clear contractual arrangements in all new and refinance LIBOR-linked loans to facilitate conversion ahead of the end of 2021. And that's either through pre-agreed conversion terms or through an agreed process for renegotiation. And then all new issuance of sterling LIBOR-linked loans that expire after the end of 2021 should cease by the end of Q1 2021. So that deadline for cessation of new sterling LIBOR-linked loans has been pushed back from end of Q3 this year to end of Q1 2021. James, back to you.
Caroline, that's really helpful. Thank you. You've managed to cover a lot of ground there, and certainly a bit of a wake-up call, I guess, for some of us who have had our heads down on the COVID-19 crisis the last couple of months. And this regulatory stuff, it just doesn't go away, does it, despite some of the forbearance examples that you highlighted. So delegates will be glad to hear that your slides will be available to download from the event portal as a bit of a checklist. And you mentioned LIBOR at the end, and I would just draw everyone's attention to the fact that there was a dedicated session on LIBOR this morning, and that session is also recorded and available to download and goes into a lot more detail on that important topic. And it struck me, Caroline, listening to your talk, that a lot of what you were describing is really about completing the regulatory reform agenda of the last decade that was in response to the last global crisis. So we'll come on to the present crisis of COVID-19 in more detail, as I outlined at the beginning. But at high level, I'd first like to turn to Subhas to really get more of an international view on this. We've heard about Europe, but Subhas, are you seeing similar regulatory priorities across Asia, the Middle East, and Africa?
Thank you, James. I think the short answer to that is an overarching yes. I think the flavor that Caroline put together at the beginning in terms of some of the easing parameters we are seeing in the UK and the wider flavor in Europe. Let me take the focus into East, Far East, and I could perhaps give a few countries examples, starting with Singapore, and then I'll sort of mention a few points around what are we seeing in Japan, Australia, South Korea, and India, and depending on time, we can sort of get into a bit more detail. I think the overarching comment, as I said, is yes, but obviously there are certain differences and distinction, and it becomes quite interesting for our corporate treasurer colleagues here on the call, who would be working for international firms. And if you're grappling with different challenges, I think we have the perfect view here in today we can share with you. So starting with Singapore, we saw, as usual, the government of Singapore on the 7th of February, so sort of pretty early in the day, they published a total different policies around sort of quantitative easing and also liquidity management. They called it DORSCON. I don't know how much you have heard about it. disease outbreak response system condition, and that was announced by the Monetary Authority Singapore at the Singapore Parliament on that particular day, targeted to all corporations and all financial institutions operating in the country. Some of the key features of that, and I think there are now sort of different versions of Dawson being issued, but some of the key features, if I sort of quickly go through. So 60 billion Singaporean dollars worth of soft facilities have been agreed with the Fed, US Fed, for quantitative easing, and obviously liquidity is a big enabler of that. That goes at the heart of some of the regulatory points, including SFTR that Caroline has mentioned earlier. In addition to that, we also saw the Monetary Authority, which is also the central bank, coming out with an updated version of monetary policy on the 8th of April, which provided further regulatory guidelines. And if I sort of go through some of that, that includes 1 year deferral of all Basel III reforms to the minimum of 1st of January 2023. That's sort of the government guidelines. And they also say that this is something the government and the Singaporean Monetary Authority have been in discussions with BIS, also with European Banking Authority. There are some other additional relevant easing that I think it's important for us to mention here. So one is now there is an allowed principles that banks and other corporations can use their liquidity buffers to meet their additional liquidity demands, which obviously goes against the principles of stress testing, as you all would know, and many sort of industry veteran would know sort of the sticky points around that, which is sort of perhaps unimaginable even a few months ago. In addition to that, sort of another interesting point mentioned, it is now allowed to use capital for regulatory loss allowance reserves, which is effectively you're moving capital for loss allowance reserves on the left-hand side of your balance sheet or on the liability side, which is again sort of big push around quantitative easing. They have also suspended for the time being, and there is no sort of end date with a monthly review being on for all on-site inspections. Any regulatory submission deadlines have been extended by minimum 6 months. And also the final point to mention on here is reduction in capital and liquidity requirements by banks and also by big corporations by at least 35% of the important requirements. If you sort of look at under FRTB and also under Basel I and Basel II, the 7.5% and then 12% top up on the top would be reduced by 35% for the time being, which is a big change on the way.
And Subhas, can I apologies for interrupting, but can I just check so a lot of these measures aimed at the banks and indirectly I can see help corporates where, for example, capital buffers can be released, which you described. Are many of these regulations directly applicable to corporate treasurers, or is it more the indirect impact of measures aimed at the banks that you're seeing?
I think a combination of direct and indirect, because if you look at some of the bigger corporations, particularly in a city-state, financial services-backed economy, some of my direct clients that I've been in sort of discussions with big corporations, these type of quantitative easing really helps in terms of their working capital mobilizations and also future financial resource management. And
is that what you're seeing generally across the Far East region? I think you mentioned in your introduction, Japan, some Australia. And particularly if you can bring out for treasurers who are in those regions, and indeed, as I said, we've got 80 countries represented. What are the things they might need to look out for that are perhaps in addition to what we're seeing in Europe, which Caroline described?
Sure. No, that's very useful. I think the first sort of answer to that question is yes. So let's perhaps move on to Japan and some of the measures taken by the Japanese authorities, including the central bank, but also the regulators. So we saw about a month ago, again on 9th of April, the Bank of Japan started issuing the treasury bills and also the 3 years bond that sort of now come out, and that's again available for the treasurers to consider. with an interest rate set at 0 for the 3 years. There is a version which is only 12 months with a very, very attractive interest rate of minus 0.1%. We haven't yet seen how is it really going to work out, but we are already seeing, talking to some of my colleagues and friends and clients in that side, this is obviously some of the useful predicaments here. On the April 27th, the Japanese regulators also introduced some additional monetary easing guidelines. They have also issued a special fund to supply additional funds, which is in force. We have been checking with the central bank and also a few other administrators there in terms of what's the closing timeline, what is the top level of that fund. For example, you would have known that European Central Bank, ECB, said that they would issue that fund to the extent of 800 billion euros. The Japanese have said that there is no top limit at this point in time. They are definitely looking at the economy sort of, plunging down if they do not enforce some of these measures, which is interesting. The two other sort of interesting points. One is around the repo regulations that I think the earlier speaker has mentioned in the UK. The Japanese principles sort of very much in line with what the UK have sort of promulgated on that area, so it will be available for the time being. The other point I wanted to mention is also around the benchmarking index, and sort of, as a part of that whole quantitative macro level indexes on benchmarking. It used to be 37.5%, so sort of quite high on the financial stability. It was reduced to 32.5% on the 2nd of March, and then a couple of days ago it was further reduced to 26.5%, which sort of shows the interest of the government to share cheaper capital and cheaper credit to effectively run the treasury and to effectively run the economy going.
Subhas, that's brilliant. Thank you. And clearly, a lot of detail there. But what struck me, I think, is a lot of what you're describing, just from the couple of example countries that you picked from the Far East region, is actually a lot of the regulations there around the banks, around capital requirements, around monetary easing, particularly in response to the current crisis. Perhaps I'm just sensing, reading between the lines, perhaps slightly less regulation aimed at corporates than we're still seeing coming out of the EU. And I'll shortly circle round to Tarek on that question, because he represents the European Association of Corporate Treasurers. But before I do, just to make sure we're really trying to get a global scope here, Brian, it's maybe a bit unfair that because you're the Canadian citizen, I turn to you on North America. But I would be interested to know, as a specialist on EU legislation, but with your North American background, are you seeing in America similar sort of trends as Caroline described in terms of regulation directly applicable to corporates? And also, as a bit of an unknown there, how will the US presidential election maybe either accelerate or delay necessary legislation that affects corporate treasurers? So, Brian, over to you, please.
Wow! Somebody giving me a free pass to talk about U.S. politics. As a Canadian, you should know that's quite a dangerous thing to ask a Canadian to do. So maybe I'll pass on that for a moment. But I wanted to come back to you've spoken about how so many of these measures, and it's true with the North American measures as well, that they're really focused on the corporate, or sorry, on the banking sector, on sort of preserving the ability of the financial sector. And so I think, big picture to me, what's going on here and why should this be important to corporate treasurers is that effectively what they're trying to prevent. I think policymakers are really trying to prevent what's a gathering economic crisis from also becoming a financial crisis for the financial institution. So how do we effectively keep liquidity flowing in to companies and to individuals where it's needed in the economy, and a recognition that the financial institutions, the banks primarily, but also asset managers and others, play quite an important role in making sure that that those flows because of the touch points they have, that those flows continue. And so a lot of the things that Caroline talked about were also about, and she pulled out a really good example about from ESMA about making sure that that things stay as much the status quo as possible for many of the corporates in terms of their relationships and the way and their access to finance in the economy. So I think that's, to me, that's the real, that's the crossover. It's worth paying attention to kind of how these policy measures are affecting the the financial industry, because if we do wind up with an economic crisis becoming a financial crisis, then that brings into play a whole other set of questions for corporate treasurers, and I think we'll touch on that a little bit later in the in our panel. But I just wanted to add a couple of notes, actually three things that came to mind. One, in terms of regulatory policy and forbearance, that a number of jurisdictions around the world are really looking at rules around kind of corporate reporting as well. So delaying corporate reporting, recognizing, as my colleagues on the audit side of our business have pointed out, that it's really important to maintain audit quality through this crisis, and that people have confidence in the audits that are provided. And so if those need to take a bit longer because auditors are not able to visit premises, then they should take a bit longer. And so generally, I think in the UK, there's been a 2-month delay to the reporting requirements for a number of corporates. So that's one area. I think at the European level, that in addition to the measures that Caroline talked about, there's a number of discussions about kind of quick fixes that may be entered into, and maybe Tarek can also talk to that. But I think I'm hearing that there's that there's potentially a package around MiFID and also around the benchmark regulation in Europe, where there may be additional fixes introduced during the German presidency, which is the second half of this year, with a real impetus to sort of bring them into law quickly, so that they can be effective and help with the crisis response. And the third area I thought was important. It's been sort of mentioned by both speakers, but maybe not directly, was really the bond buying programs, the quantitative easing by the central banks, and the recognition that how important it is that there's liquidity out there. And so we've seen the central banks quite aggressively involved in corporate bond buying, not just the European Central Bank, but in other places, and kind of looking again at their rules for doing that. So understanding the importance of liquidity in the marketplace. So I think that those are, I think from a PwC point of view and from an accounting point of view, for the financial services industry, there's this notion of expected credit losses as well. And so, in Europe, in the IFRS 9 is the rule that's getting a huge amount of attention right now. And as Caroline said, the rules are, there's a great encouragement that people should apply more judgment and that and take into account the government programs in terms of factoring these sort of support measures into their calculations of expected credit losses. In the last crisis, of course, the accounting for credit losses in Europe was really done on a as the losses were incurred basis. So if you kept things on your balance sheet, you didn't necessarily have to recognize the losses. And so we've endured a very long decade where a lot of banks have struggled to provide lending into the markets because of having non-performing loans at some level within their balance sheets. And so IFRS 9 is intended to clean that picture up and to do it quickly. The experience of U.S. banks in the last financial crisis was a much quicker recognition of the losses that had been incurred and a cleaner kind of clearing up of their balance sheets and of their return to the market in terms of providing lending. So IFRS 9 is intended to work this way in Europe and in other places around the globe that have adopted the international accounting standards. And there's a massive focus on this because, of course, at the end of the first quarter, for instance, in the UK, the provisions that the banks made for credit losses, I think, were £7 billion on kind of a 2% drop in GDP. But as we get into the second quarter and the results come out, if we've got on the order of a 30% drop in GDP, what do the expected credit losses look like for that kind of a change of economic activity? And therefore, what are the right policy responses in that situation? But I think that's probably enough on that for now, and I'll hand it back to you, James.
Brian, thank you. That's a very comprehensive overview. And so if I understood rightly, your important point about IFRS 9 is, and this is particularly for those treasurers operating in countries who perhaps are less familiar with the issue or maybe don't have the international financial reporting standards, is that at the point of the bank advancing the loan to the corporate, it has to anticipate and book the expected loss at that point right up front, and therefore that can act as a brake on the ability of the bank to lend. Is that a fair summary, Brian?
Yeah, it has to account for it certainly on a quarterly basis as it reports, and so these things come up very quickly, and so there's a real there's a real linkage between the calculation of expected credit losses and the bank's ability to lend in a consistent way with corporates, and that's so you've really hit the nail on the head. It's what's the behavior of the bank's going to be when they as they conduct these expected credit loss assessments.
Thank you, Brian, for clarifying. So one of my personal takeaways then from what we've heard so far is that it seems that although this session is about the regulatory hurdles for corporates, that actually there's a lot of international regulation that all of the three speakers so far have described, which is aimed at the banks, but indirectly might actually impact on the bank's ability to serve its corporate clients. And perhaps that's something that treasurers need to be watching out for, not just what regulation is coming their way that directly applies, but also how will regulation aimed at the banks be changing the bank's relationship with them? So at this point, I'd like to bring in Tarek, if I may. So Tarek, I know you speak with treasurers all across Europe and probably wider through the International Group of Treasury Associations, as indeed we do at the ACT. Really giving you a very open goal here in terms of which regulatory changes do you think will require the most attention from treasurers over the next year? So again, trying to avoid that we get too much into the detail of COVID-19, which we're going to move on to in just a minute. But what else is there on the EACT's radar screen that perhaps is significant to treasurers, but maybe we haven't touched on yet, if anything?
Well, maybe I think it picks up to an extent on quite a number of the points that Brian was making around. He alluded to the word quick fixes, which is a term that has emerged on the European scene in the last couple of years, which basically implies a relatively, because normally the European legislative process tends to be quite prolonged due to a number of institutions being involved at the same time and a multitude of actors that drags out the process. So there's been a sort of recent emergence of whenever very pressing problems arise, there's an effort to accelerate the legislative process through quick fixes that have a limited scope. And maybe just to start off and just to echo very much what the previous speakers have said, I think what we've seen so far has been very much a regulatory effort focused on alleviating some of the burdens on the bank side to enable them to be that sort of crucial transmission mechanism between the fiscal support schemes that have been put in place by central governments and by central banks to then what is coined as the real economy. And in that context, I think from a Treasury point of view, what is key to watch out for at the moment and coming down the line are, I would put broadly speaking into, I think, two or three buckets. One is what are the implementation deadlines that we're looking ahead to that have not moved, where the goalposts haven't been shifted. And Caroline was mentioning at the beginning, EMIR refit changes coming in June. Mm-hmm. That is, of course, from a corporate treasury perspective, a helpful change. And it's certainly very helpful and encouraging to hear that ESMA has not gone down the route of forbearance on this particular one. And similarly, there have been some forbearance statements on sort of transparency requirements for annual reports and moving some of the deadlines there to lift some of the burdens in sort of treasury functions and in the corporates. But I would point more towards the sort of legislative agenda that is coming down the tracks in terms of some of the quick fixes that were already mentioned. So we're expecting at the moment, as Brian was alluding to, a reopening of MiFID. There's a reopening of the European benchmarks regulation. Both of those are likely to be proposed in June, July this year, with the hope of sort of wrapping it up fairly quickly by the end of the year. And I think certainly within the EU benchmarks regulation reopening, there are some aspects from a Treasury perspective to look out for in terms of what may or may not be done around critical benchmarks and linking over to the sort of the issue of LIBOR transition. And then there's an issue within there around the restrictive rules that are in place at the moment in the benchmarks regulation for use of third country benchmarks, where there's a sunset clause that would restrict use of those indices at the end of 2021 or after the end of 2021 in the absence of the usual EU equivalence decisions and access grants. And there's an effort
sorry, Tarek, I was just going to say on the benchmarks point, you might want to just elaborate a little bit on the FX implications there for treasurers, because I suspect that some treasurers might not actually be aware of this issue, and indeed it affects, if I understand rightly, treasurers perhaps operating in the EU, but relates to FX that's out in, for example, the Far East or the Middle East. Perhaps you could elaborate.
Precisely. Absolutely. Thank you for calling out on that, James. So the issue there is very much one where at the time of the initial EU benchmarks regulation, the EU had chosen to implement the IOSCO principles for financial benchmarks in the form of a regulation, which at the time had a very wide scope, which was done deliberately by policymakers in the hopes that other jurisdictions or other major jurisdictions across the globe would follow suit and implement their own regulatory frameworks. Fast forward a couple of years to now, and we're in a situation where Europe is the only jurisdiction, or one of the very few jurisdictions, that actually has implemented a very stringent regulatory framework on top of the IOSCO principles. And what that means is that because of the benchmarks regulation as it is at the moment includes a general prohibition on use unless recognized in Europe for use for any third country benchmark that is in scope of where the type of benchmark is in scope of the EU BMR. And the issue from a treasury point, and then specifically on the FX side, is that there is a number of FX spot rates that are being used in non-deliverable forwards to hedge currency risk in jurisdictions with non-deliverable currencies that would cease to be available for use for EU counterparties in their hedges and in their NDF products after the end of 2021, for the simple reason that the administrators of those rates, who are in many cases even central banks of the third country jurisdictions, have chosen not to go through the arduous process of having their rates recognized for use in the EU. So the issue here is very much that unless changes are made to the scope of the benchmarks regulation and the way the third country regime works, then all of those benchmarks would cease to be available for European counterparties, which of course is overall a fairly undesirable situation to be in. And I think policymakers at the EU level are very aware of this. And that is also why the review of the benchmarks regulation there's an attempt to do it through a quick fix that is hopefully accelerated to allow for it to be done before the end of the transition period. And the other aspect that is the other big piece of legislation that is being reopened is MiFID. At the moment, it looks like it would be mostly limited to some aspects around investor protection. But the trouble with a very politicized piece of legislation like MiFID is that once it's open and on the table, there is a very strong likelihood for things to be added on. Whether that is of relevance to corporate treasury remains to be seen. But there can also be a resurfacing of questions around whether certain asset classes should be in scope for the transparency regime of MiFID, in particular FX spot. So all of those issues are something to keep an eye on from a corporate treasury point of view. And I would just point out the other sort of more long-term sort of issue to watch out for is, in essence, through the public fiscal response to COVID, and I know you said, James, we shouldn't talk about it, but through,
yeah, we'll move on to it.
as a result of, you will see a ballooning of public debt levels, which will need to be financed or serviced in some way, which ultimately means there needs to be some form of increase in tax receipts, which then channels back to a favorite subject of everyone who's sort of engaged in financial services and also amongst the corporate treasury community, which is the financial transaction tax, which has been around for discussions for a number of years and has been reshaped, rediscussed, had new items bolted on, issues taken out, but ultimately it has been raised again in very public discussions in the last couple of weeks as one of those aspects where it could be brought in to bolster public coffers as a result of sort of some of the lost tax income or sort of ballooning public debt levels. And that obviously links over to sort of equity derivatives in general, to what extent, what kind of products would be scoped in, which asset classes, etc. So maybe just to highlight those, and I think I've spoken long enough, and maybe we can move it along. But if there are any questions, I'm obviously happy to discuss further.
Thanks, Tarek. And actually, it was a good segue because indeed I do want to now look at the legal hurdles associated with the current COVID-19 crisis. And it seems that what we've heard so far is that even before the crisis, already we would have been very busy as treasurers with a lot of regulation going on. And it's almost like being a racehorse in a race where you're going over a whole series of jumps and suddenly someone adds on about another 10 jumps ahead of you, just as you think you're getting near the last one. So Caroline, if I could maybe turn to you to summarize some of the specific legal and regulatory hurdles that you're seeing as a result, particularly businesses carrying on business working from home as a result of the crisis, and that's a global trend. And indeed, some countries are further ahead than others in starting to go back to work, but that might in itself cause regulatory issues where you've got some staff working, some not. Okay, could you just elaborate on that, please?
Yes. So, I mean, I suppose that there's a couple of themes that, and so as you say, there have been a number of issues which have been raised by the unusual situation of having significant numbers of staff working from home. So, for example, if you're looking at holding company meetings, if you're holding board meetings, AGMs, does your company actually have the ability to hold those meetings remotely? Is that a matter of changing the statutory documentation of the company, or is that a question of law? And I think in some jurisdictions we've seen changes in law to allow companies to have their AGMs remotely. I suppose on top of that, practicality of whether or not you can actually have the meeting, you've got the questions of cybersecurity around the link over which you're holding your meeting, so that there are quite a lot of practical issues that come up there. I think aside from that, people have been looking at the question of execution of transactions. So if you've got people working remotely and there may be not able to accept physical delivery of documents, or they're not able to sign documents, have you got the kind of transaction where you need a wet ink signature, or is it actually going to be possible to have some kind of e-signature? What are you looking at to print and scan from home? So that sort of approach might not work. Do you have access to a platform like DocuSign? So again, we're seeing a number of questions coming up around that. I think probably one of the other issues has been around location of employees and whether that triggers tax consequences or licensing consequences. So particularly where we've had people who are now working from home in a jurisdiction that isn't necessarily the jurisdiction in which they'd normally work. So people who live in a different country from where they work, a different state from where they work, or even people who were trapped away on holiday or on business, who are now temporarily in a jurisdiction which isn't the one where they normally work. And all of these issues really raise questions of the tax consequences and the licensing consequences for their company.
So, Caroline, that's very helpful. I've got some questions coming through on the Q&A, and there's a sort of cluster of questions which are they're about. I think I'll turn to Subhas for this one, because it's many treasurers around the world are participating in new funding schemes introduced by governments. And there's a sort of theme of questions coming through, which is, are there regulatory risks for corporates who apply for state funding, or indeed, as a result of the crisis, will there be increased regulatory oversight of corporates and activities? And perhaps would corporates have to comply with state aid rules or with government restrictions on dividends and bonuses? Subhas, is that a theme you're seeing globally?
Yes,
sort of concerns?
I think absolutely. I mean, I have been having conversations with many of the corporate treasurers internationally, and particularly from Far East. I mean, one of them, maybe the way I answer is sort of give you an example. So one of them told me that in the last 5 weeks, there may be around 400 exceptions to the standards and rules that the gentleman and the team has sort of, had to take because of the exceptional scenarios we have been through. And I think some of the guidelines we are seeing, in Singapore or Japan or Australia, it is pretty clear that, although some of the quantitative easing and some of the liquidity allowances have been provided, I think the regulators have been pretty clear that in terms of internal control mechanisms, in terms of ensuring some of the compliance requirements, which are expected from a good practice perspective, will need to be adhered to. So I think we are in a scenario here that, yes, we have some levers and we've got to work with it, but make your judgment very clearly. That would be my personal advice. If you are making some decisions, certain decisions, which is impacting your organizations, your corporations, then you need to have appropriate rationale. And please ensure you are documenting your decisions. Please ensure you are involving your exco and the senior management on those decisions. And that relates to everything. That relates to you investing into T-bills or corporate bonds in your particular country, in your jurisdictions. That also relates to if you are changing your adjustments based on some of the benchmarking points I think Tarek was mentioning. All of that, ensure you're keeping appropriate documentations.
Thank you, Subhas. And I'd like to bring Brian in here, because Brian, just picking up on an earlier comment you made, you were talking about some of the financial reporting hurdles and disclosures in the context of the crisis. Could you just elaborate a bit more on going concern discussions with auditors? Particularly, I think a lot of treasurers are concerned at the moment that where they are having to have a going concern discussion with the auditors, that might in turn cause breaches of covenants, perhaps. And so how are treasurers supposed to approach these discussions, and similarly discussions they're having with their rating agencies, which might also have an impact on covenants?
Yeah, well, I think that for particularly the discussion around covenants, there's a very helpful joint statement issued by the FCA, the Financial Conduct Authority, the Prudential Regulatory Authority, and the Financial Reporting Council in the UK in March. highlighting where where covenants are concerned, that banks should treat breaches that are related to COVID, differently than they normally would. So there is some guidance from the regulators specifically on that issue that I think is helpful. I know that's UK guidance, but I think it is the sort of thing that other regulators around the world will also sort of pick up and follow as well.
Mm-hmm. Brian, thank you for that. Just looking also at the questions coming in, it's almost impossible to get through any regulatory session without the word Brexit featuring. And this is a global regulatory session. So I think what we're seeing is Brexit perhaps as a symptom of protectionism or nationalism that's perhaps occurring more so now in the event of the COVID-19 crisis. But I would like to ask Tarek. Tarek, you're based in Brussels. Do you think European treasurers really are focused on forthcoming Brexit? So Caroline outlined the fact that the transition period will end in December. There's not a free trade agreement. But I'm especially interested for this call as to the impact on treasurers who perhaps are based outside of Europe or the UK, but who have goods or services going into the UK and Europe. So should Brexit be on international treasurers' radar screens, or is it a very localized issue?
That's a loaded question, James.
It is.
I think, and maybe at the risk of simplifying it a little bit, I think the one aspect to watch out for is the precedent that the trajectory of the Brexit discussions so far, and whichever trajectory it will take in the next 6 months or so, is worth keeping an eye on in terms of what precedent was set for market access rules for the rest of the world into the EU. So having said that, I think it's also worth highlighting that the UK is a specific sort of test case for the EU flexing its market access muscles. And I think the two aspects to watch out for in this context, I would highlight, are access to venues, so trading venues for FX and hedging purposes, and then generally multilateral trading facilities for share trading and derivatives trading. And the other aspect is access to central clearing houses for cleared derivatives. And I think in those two scenarios, there's the way the discussions will go with the UK, and all indications so far are that they're not going to be going into a most beneficial direction, at least from a UK point of view, is something to watch out for corporate treasurers globally in terms of what rules the EU will impose for market access going forward, or whether they will choose to require more sort of substance requirements in the EU in exchange for market access, to what extent some national permissions regimes under MiFID, for instance, that still operate at the moment, will be closed off in favor of more harmonization at European level. And I think in that sense, it's also worth highlighting that from a European point of view, it's always been sort of, it's less about hard power, but more about soft power, and regulation and standard setting has always been sort of the way in which the EU has projected some of that soft power. So I think it's just worthwhile tracking those discussions to see where they land, as it may set a precedent for discussions sort of for other jurisdictions. And I know that on the cleared derivative side and access to clearinghouses, there is an ongoing discussion with the US, which has turned more or less acrimonious at certain points in the last 2 years, about application of direct supervision by European supervisors to entities located in third countries. And I think you'll see that logic being replicated across the whole value chain of financial services to an extent. So I think it's just worthwhile keeping an eye on that.
So Tarek, you've done brilliantly, because it's worth probably an hour or two in itself on Brexit, but it is important to keep it on people's radar screens. And clearly, for those people who think somehow the bank's going to sort all this out, actually corporate treasurers need to be engaged in this process. Well, we're just about at the end of our time. Literally, I've got, before I wrap up, got 2 minutes, so that's less than 30 seconds each, where I just like to look to the future. A lot of people are starting to talk about building back better after this crisis. We started off by saying that the last global crisis gave birth to a whole decade of financial regulation. So if you had your sort of 20-second wish list of what piece of regulation would you like to see to help us build back better over the next decade, what would it be, Caroline? Just to put you on the spot.
I think probably one of the themes for the next few years is going to be ESG, and people have talked about maybe whether the ESG agenda is on hold because we've seen some specific aspects of it being put on hold. But I think certainly if you look at least in the EU, the message that's coming out of the President of the European Commission, Ursula von der Leyen, is saying really that the European Green Deal needs to be at the heart of Europe's recovery. And she's talking about the current crisis as being an opportunity to rebuild European economies differently and to make them more resilient. I think it's probably also worth remembering that ESG isn't just about the E part of it. It's not just about the environment and the climate. And that COVID-related disruptions also raised a number of social issues. So there's an increased focus on healthcare, the value of key workers. And I think certainly in the financial sector, there's much more of a focus on conduct-related issues. And you've seen a number of regulators talking about banks' obligations to their borrowers, and starting to dig into some of those behaviours around relationship management and the interaction between the lending relationship from a bank and then maybe their support on equity raisings as well. So I think probably those are going to be two areas where we see a bit of activity.
Thank you, Caroline. We're just about out of time, but I mean, what I'm hearing is Treasury should maybe expect to comply with new principles around stewardship and social responsibility. Just literally 10 seconds, please, from Brian. Is that an area you would agree with, or you see some totally different area?
Yeah, totally agree, but also need to mention digital and digital and cyber issues, AML. But I'm also really concerned about the COVID crisis and the depth of the crisis and the need for policy responses that we haven't seen so far, that we're going to need sort of bad, I think we're very likely to need bad banks. What's the extent to which you can solve a solvency crisis with more loans? Probably not. So you're going to have to look at kind of ways of injecting equity and dealing with some of the state aid rules. So there's a lot to do in the short term around COVID.
Thank you, Brian. And Subhas, literally just the final 10 seconds from you, please. Would you agree with those, or you have one other item to add into our shopping list of regulation?
I do. I think the future point around competitive positioning and particularly the importance of operational resilience. And this particular crisis has shown the importance of treasury and liquidity for the future of financial services, also for corporations. I think those are sort of some of the important points we all need to think about.
Thank you. And we've reached the end of our time, and we hope that everyone has found this session informative. Thank you to those of you who contributed questions. And we've tried to cover as much ground as possible, and apologize to anyone who didn't get their particular question answered. But we will be continuing the conversation in the discussion forum on the app, so please visit that. Please also take time to complete the feedback survey. These are very useful for planning future events. And on behalf of the audience, may I thank our excellent panel. They've taken such a big topic today, managed to cover something for everyone, I hope. Brian Polk, Caroline Dawson, Subhas Roy, and Tarek Tranberg. And I wish good health to all participants and your families. This has been James Winterton for the ACT. Thank you very much and goodbye.